All right, hello everyone. Welcome to today's session. For those of you who do not know me, I am Joe Salvatore. I'm part of the CCM team, and I am also the youngest in the office. So by default, I am the IT person and also the Zoom engineer now. Before I hand things over to Randy to go through his presentation, just have a couple things for you. Firstly, this is a webinar series that we are doing. So this is the first of 4 scheduled webinars that we currently have. Do look out in your email for future registration. So every Thursday, we'll be sending out the registration to sign up for the webinar for the next week. So keep an eye out for those. If you do have any questions during the webinar for Randy, so the way that we will do it is if you highlight your mouse over the screen, there is a Q&A option at the bottom you'll see pop up. You can type your question in there. After the presentation is over, we'll circle back and answer the questions at the end. I will ask the questions to Randy, any of the ones that were typed in during the seminar. And lastly, this webinar is being recorded. So everybody who is attending this webinar, any questions that you ask, that is all private. Nobody can see that besides myself and Randy. And then we're also recording it, so for the people who couldn't attend the webinar, or if you guys want to watch it back in the future, after this is all over, we will edit the video and then send it out in an email that everybody can view at any time they'd like to. So with all that being said, I will hand things over to Randy, and I will come back at the end for the questions. Thank you, guys.
Hello, everyone. Hi. I hope everyone's doing well. What a crazy time we're living in. It's been, I believe, 6, 7, maybe even 8 weeks since our office has been closed. Everyone's working out of their homes, basically. I try to come into the office every day, and our staff's working out of their homes remotely. We are here for you. Anything that you need, any questions you have, any concerns that you may have, please give us a call. We try to get back to you right away. Sometimes it may take 24 hours, but we do try to get back to you. So I want to thank you for joining us today. As Joe already mentioned, this is one of our 4 webinars that's already scheduled. So some of the information we'll be sharing with you today may not answer all your questions, but hopefully by the time that we're done in the 4th seminar or webinar, we'll be answering some of your concerns at that time. Again, this is our very first one, so we're just getting used to using this Zoom. Joe certainly knows a lot more than I do, but I'm very thankful for our staff because they are able to set things up and allow me to communicate with you at this time. So today we're going to be talking about required minimum distributions, Secure Act, and a CARES Act that went in the March. So first, the Secure Act, which was enacted by the House of Representatives on December 17th, and 2 days later, on the 19th of December, Senate has approved it, and President signed the act. Secure stands for setting every community up for retirement enhancement. The retirement legislation include policy changes that will impact your defined contributions, typically is known as 401ks, 403bs, deferred comps, and TSPs, and defined benefit plan. They're known more as is a pension that you may receive after you retire from an institution or the government, that they pay you monthly income, that they're called defined benefit plans, as well as the individual IRAs, individual retirement accounts, and 529s. And then 3 months later, at the end of March 27th to be exact, CARES Act went in. CARES Act stands for Coronavirus Aid, Relief, and Economic Securities Act, and it provides the estimated amount of $2 trillion It's a fiscal stimulus amount of money went in. Obviously, they want to boost the economy. The economy has pretty much came to a halt. We were doing well all last year at the end of the year, especially at the beginning of this year. But after this virus, things have changed drastically. So government, both the Congress as well as the president, is trying to get the economy going by stimulating, by adding more money to the economy. Let's first talk about the Secure Act and some of its highlights. One of which is required minimum distribution. Most of you know, or you should know, when you retire, at some point back in the days prior to this year, when you turn age 70 and a half, you had to take the required minimum distribution out of your IRAs and 401ks. Meaning that even if you don't need the money, you had to pull some money out of your qualified account, IRAs, 401ks, TSPs, so that government will get their share of the taxes, and they want you to spend some of that money so the economy will grow. Well, that has changed. Anybody whose birthday has, as of July 1st of last year, if you did not turn age 70, which means if your birthday was a June 30th, obviously by December 30th, you would have turned 70 and a half. If your birthday was prior to July 1st of last year, you still have to take the required distribution starting this year in 2020. However, if your birthday was after July 1st of 2019 and you turned 70 after that time, then you do not need to take any required distribution until you turn age 72. This is a good news for some of you. Some of you have asked me in the past, why do I need to take this money out of my IRA account, my 401k account, my retirement account, when I don't need the money at this time? Well, the government said that you had to, but now they extended that to age 72, which means you have a couple more years, a year and a half, to defer your account a little bit longer so that you feel that you could grow a little longer to have a better return on your investments, and better future needs can be covered through that. Now, RMDs starts at age 72 starting now, not 72. That also gives a great opportunity for you to put money away into an IRA account during the time. Unlike the past, starting now, even after you turn age 70 and a half, if you decide to go to work and if you decide to put some money away, you're able to put money into a retirement account and take the tax deduction beyond the age of 70 and a half. So if you decide to work part-time, and as long as you're working at least enough to earn $6,500, that you're able to put all that money away so you pay zero taxes for that amount. If you're married and you file your taxes jointly, you could put away up to $13,000, meaning that one of you, if you work part-time and earn $13,000, if you decide, you could put all that money away for the future by taking the tax deduction or not paying taxes on the money that you have earned. That also is a great opportunity that you could do for yourself. Here's an example of how you could help yourself after you turn age 72 and you decide to still work at that time. Let's assume that you have $350,000 in all your qualified account, you and your wife's combined, or your husband's. So if you have up to $350,000 at the age of 72, when the required minimum distribution must be taken, at that time, you have to take somewhere around 3.8 to 3.9% of the value of your account as the RMD, required minimum distribution, which in turn comes out to be about $13,000. So here's what happens. Let's say, in an example that I want to use, let's say that you are currently living off from both Social Security and pension somewhere around $50,000 a year, $4,200 a month. But because that was not enough to pay all your bills, And also it happens that you had enough money into a qualified account to take the RMDs of $13,000 that you need extra. So if you are getting $50,000 from your Social Security, yours and your spouse's, and maybe a small pension plan that was generating a $50,000 a year in income, and if you're getting a required minimum distribution of your accounts around $13,000, your taxable income would have been $63,000, 50 plus the 13. Now, here's an opportunity. Let's say you decide to go to work, or you don't mind working, or you just decided that you don't want to quit even after the age of 72. I certainly want to plan on working beyond that. So if you decide to do that, then here's a great tax opportunities. Oh, keep in mind, folks, I do want to disclose, I am not an accountant. I am not an attorney. However, I deal with a lot of numbers. So whatever I go over with you, if you have a specific questions about taxes, please talk to your tax advisor about that. Now, going back to the idea that I had, if you decide to work part-time, your spouse decide to work part-time, and you earn $13,000 and you're age 72. Well, normally, before the tax law change, you would have gotten $13,000 from a required minimum distribution out of your $350,000 of qualified money or retirement money, and $50,000 from your Social Security and a pension, and $13,000 from an earned income. That means your taxable income would have been $76,000. Well, guess what? Because of the IRA, it's a new rule that you're able to contribute to the IRA beyond the age of 70 and a half. If you decide to put that $13,000 away, you're still getting $63,000 in your pocket as you plan on getting, and $13,000 that you would have gotten in RMD is mitigated by you putting that amount away in an IRA account. I know the numbers can be confusing, so please call me. Please make an appointment, whether it is by phone or whether by Zoom, or hopefully by soon, we may be able to meet face-to-face. Get and talk with me so that we could go over specific numbers based on your needs. Now, there's another rule that went in for part-time workers, and the number that I share with you, 13,000, certainly can be considered as a part-time for most people. So if you decide to work part-time, now, as long as you work either 1,000 hours in any given year or 500 hours per year, averaging out in 3 consecutive years, then you're able to put money away in a company-sponsored 401ks, SEP plans or simple IRAs, any plans that's offered by your employer. In the past, if you did not work full-time, the company did not have to offer you that benefit, but now they do. So if you're in that situation, certainly you should take advantage of that by putting more money away for your future. Now, at this time, I want to talk about the inherited IRA distributions. In the past, when your parents or grandparents passed away and or IRAs or their retirement money came to you, you had an opportunity to either accept the money, pay taxes on it all at once if you wanted to, or with the proper plan, you could have paid taxes over the next 5 years. So you have different options. But starting now, you don't have an option of stretching your IRAs forever. So there is no such thing as a stretch IRAs anymore, which means that if your parents and grandparents have left you IRA money, retirement money, you must take that and pay taxes within the next 10 years. So you have a limited amount of time. That can be problematic. Not everyone has a lot of money in a retirement account, but I do have a lot of clients, or some clients have that. So let's use an example of someone, let's say my parents, most of you know my dad passed away, but if your parents, both husband and wife, your parents were living And if they happen to have $500,000 in an IRA account and they both passed away, and let's say that I'm the only child, that money would come to me at $500,000, which means within the next 10 years, I must take that as an income and pay taxes on it, even if I don't need it. In the past, I could have deferred that to a lot longer. So during my lifetime, I could have deferred that and pay very little taxes. I don't have that option anymore. So, which means on an average, that $500,000 income I'll receive, I'll take $50,000. Again, I'm just using it as an average number over the 10 years. I have to add $50,000 to top of my own income and my wife's income. That could increase my taxability to quite high, which I wouldn't like. So there are some options that you could consider. There are some planning you could do to mitigate these taxes as well. And again, I ask that if you have any specific questions or want to talk further about that, you're welcome to give me a call so we could go over this with you, either face-to-face or by Zoom. Now, here's a great opportunity for those of you who are still wanting to have a child, either by birth or adopt a child through adoption. If you decide to have a child, and typically nowadays, I know my wife did when we had our kids, typically when you have a child, you may want to stay home for 2 to 3 months. And during that time, a lot of places do not pay you your income all the way through. Well, here's an opportunity. If you have a child, either by birth or adoption, you could take the money out of your IRA account or 401ks, up to $5,000 per parent, which means if you're married or have a spouse, that's $10,000 total. You could take it out from your retirement account and pay no penalties to that. Obviously, you got to pay taxes on it, but that's no different than if you had to earn income, the wages, by going to work and had to pay taxes on it. So by doing so, if you're not 59 and a half, you're in the 40s, you're in the 30s, and decide to have a child and need the money, you're able to take the money out of your qualified account and pay no penalty and be able to use that for your bills that you'll get. Even if you have to have a child or children, you know your bills go up, it doesn't go down. So this opportunity is there for you to take advantage of now. Now, let's talk about 529. Some of you know this thing as a college deposit or money that you set aside for college funds. 529 was set up many years ago, and now it has become very popular. Either by parents or grandparents were able to put money away, and any earnings on it would have been tax deferred. And as long as you paid that, use that money directly to your college cost, you were able to not pay any taxes on the growth. Well, guess what? There's an additional benefit that went in since the new law went in. And new law says that if you do not exhaust or spend all the money out of your 529 plan and your child or kids have graduated from college and you have money left over, guess what? You could use that money up to $10,000 to pay the loan interest or loan. So when the child or your kid graduate from college, you could use that to pay their college costs or your loan. And that will be a huge benefit for you because now you have extra money that you have to pay off the loans that you may not want. Now let's go over the CARES Act, which was enacted on March 27th of this year. After the virus has come, after this pandemic that we're in, CARES Act was enacted so that there are some benefits that you're going to get. One of which is they're going to waive your 2020 required minimum distribution, meaning that this year for anybody, whether you're 70 and a half, 71, 75, even if you were taking RMDs in the past, if you do not need the money, you do not need to take that as an RMD. You don't, meaning that you could leave it into your retirement account, let it grow for more time until the time that you need. Who knows what the Congress is going to do for the future, but unless we change or things change with this pandemic, there's going to be a lot of other benefits going to come about. And this is one of the benefits that we'll be able to use for our clients who may not want to take the RMDs. Give us a call if you're taking RMDs set up automatically, so we could discuss that with you to see what might be best for you. Now, what happens if you already got the RMDs for this year? Well, there's a couple things that you really need to know. And it's important to know the dates. If you have taken your RMDs in month of January, then there are no options for you. You have taken the money, obviously you're going to be paying taxes on that, and you're spend whatever the money that's left. However, if you did not got the taken the money out and you took it out after January 31st, let's say you did it in February, March, even April. Actually, the law said as long as, even if you have taken out all the way through May 15th, you will be able to put the money back if you don't have a need for that. So there are many tricky rules that you got to follow, but as long as you understand the rules, understand what needs to be done, you may be able to put the money back into your retirement account without taking the RMDs out and pay taxes on an account that you may not want to touch. So here is how it works. So if, let's say, your RMD amount was $5,000 between you and your wife, or you're and your husband, or you and your spouse. Let's say you took the $5,000 out of your RMD, and you decided to withhold $500 in taxes. That would be 10%. Some of you will take 15% withholding. Some of you may take 20%. But in this example, let's say you decide to let them withhold 10% of the federal taxes, which means your financial institution would have kept $500 and send it into the IRS on your behalf. Another $4,500, the difference will be sent to you as either by check or deposited into your account. And let's say after that, you decided, because you've just found out about this law, you decided that that's not what you want. Here's what you can do. Ask your financial institutions, or out of your bank account, give the $4,500 back to your financial institutions, and they'll put that back into your account. It will be treated as an IRA account, so that money that was taken out actually goes right back in. The other $500 went to the IRS. There's nothing you can do. They will keep the money, and when you do your taxes, they will figure that in as you send in extra $500 during the time. Second option is, if you don't like that idea of only putting back $4,500 and you really want to put back the whole $5,000, here's what you have to do. You take that $4,500 out of your account, your bank account, send it back to your financial institutions. In addition, write an extra $500 check, send it in along with that, out of your money that was sitting in a savings account. Well, if you do that, full $5,000 will go back in, so that allows you to not take any RMDs even after you have done it, because you're making the changes after the fact. So make sure you do that and do it right. And make sure that you look for a tax forms next year, because you will be getting a couple of different tax reportings. One's called 1099-R, and the other one's called Form 5498. Anyway, if you have any questions about that, you could certainly call me. You could certainly get together with me, or talk to your tax advisor, so who could help you with those as well. Now, let's talk about another thing called inherited account deferral. That means in the past, when parents or grandparents passed away, you had an opportunity to defer paying taxes up to 5 years. Well, guess what? They have extended that to 6 years. There's nothing you need to do. The government will automatically do that if you decide to defer your taxes. But it's good to know that you don't have to pay taxes over 5 years. So adding one more year, each year you're going to be paying less taxes because you got less money coming into you. So let's talk about another thing called coronavirus-related distribution. Now, because of what's going on in this pandemic, The government says that they're going to allow you to get out up to $100,000 out of your IRAs or 401ks, even if you're age 59 and a half or younger. In the past, you had to pay penalty to that. Obviously, for anyone who's age 59 and a half or older, you don't need to worry about paying penalty. Well, actually, you don't need to worry about the 10% excise tax during that time, prior to age 59 and a half. And if you don't take in the past, beyond the age of 70 and a half, you had to take 50% penalty at that time. Well, now that's extended to 72. But for those of you who need the money and you're not 59 and a half yet, you're able to get the money out of your retirement account, 401ks, 403bs, TSPs, deferred comp, your IRA accounts, any of the accounts that you could take up to $100,000 if you need the money and not pay the penalty of 10%, but you do need to pay taxes, so you got to keep an eye on how much do you really need. You don't want to take the money out of your account and pay unnecessary taxes. You know, these are some of the tax planning that you should do. Talk to us, then we'll be able to help you. If you know the specific questions about tax questions, ask your tax advisor as well. But if you've been quarantined, been furloughed or laid off from your work, you cannot work because you don't have a child care thing set up, or your company closed, or they reduce your hours, you're able to take up to $100,000 out of your retirement account. Just think of that as, you know, earn income. Obviously, you're spending your retirement income ahead of time, but if you're not working and you need to pay the bills, you're going to have to do what you have to do to take care of your family anyway. So take the advantage of what's in front of you. If you have any concerns about whether you should do any of that, I'll be able to sit down and talk with you about that. Now, there's a better news. If you need the money, and let's say you decide to take some money out of your retirement account to live, and yet you don't like the idea of not being able to put that away for your future later on in life to pay your retirement account. Well, government says they're going to give you 3 years to put the money back in. It's called recontribution to your account. When you do that, the money that you had opportunity to use now goes right back to your retirement account and not pay taxes. So you get the best of both worlds. You're able to utilize or use the money that you have from your retirement account for the needs that you have today. But and yet, you also, when the jobs come back, where you go back to work and make extra money or bonuses, you can put that money right back in so that your status will go back to the original amount. Now, there's a couple things that I want to talk to you about further. Just realize your taxes are still due this year, but it's not due until July 15. Government has extended the tax filing to July 15. So as long as you filed it by then, you will not be in trouble with the IRS. So if you not have done so, start working on your tax returns and make sure you file that prior to July 15. Now, here's the one last thing that I want to leave you with. I want to give you an opportunity for a great idea that you may want to consider. Let's say that you have some money in the stock market, either by working with financial advisors like me, or you have your money in your 401ks, 403bs. I've been seeing lately the statements from my clients for month of March. First quarter was a terrible 3 months. Some of the people that I sit down with, some of the people that I reviewed have lost up to 35 to 40% on their 401ks and 403bs. Let's just use some number as an example because it's easy to understand numbers. Let's say you had $100,000 in 401k. Let's say that has gone down to 60,000. You lost 40%. Do you know in order to get back up to 100,000, you have to earn more than 50% to get it back to 100,000? Maybe up to 60, 65% to get it up there. Well, it's going to take some time to get up there. But you and I know that longer you wait, we all going to get our money back. So here's what you might want to do. Since your IRAs, 401ks down to 60,000 from 100, you may want to convert that to a Roth IRA at this time. Think about that, Roth IRA. If you change that to Roth IRA, think of it as you're converting $100,000 for IRA to Roth, but in reality, you're only paying taxes based on 60,000. So you convert the 60,000 into Roth IRA and pay taxes on 60. So when it goes back to the original amount, not like the past where you would have had $100,000 of taxable income, you would have $100,000 of non-taxable income. Again, those are some of the ideas that you may want to consider. I'd love to sit down with you, talk with you, and hopefully, I really hope that we can meet face to face. And I'm looking forward to seeing you next week. As I said, as Joe said, we're going to be having these webinars every week. We already have scheduled out for a whole month of April and middle of May. So we look forward to seeing you. If you like what you have to hear today, please come back and please ask your kids or grandkids get involved as well. More they know, more information they get, better decisions they can make. So at this time, I want to thank you for being with us. I'm going to ask Joe to come back to ask some questions that you may have. Thank you again. Joe, can you come back in?
Yes, thank you, Randy. So we do have a couple questions here. Just as a reminder, if anybody does have any questions to ask, if you highlight your mouse over the video, at the bottom in the control panel, you'll see a Q&A box. You can ask them there. So the first question that we have, if you signed up for automatic RMDs, will you be asked to not withdraw, or do you need to notify them?
That's a great question. It all depends on the institutions that you're with. You know, some insurance carriers who hold some of your annuities have each annuity companies, each insurance companies will act differently, as it will be with the TD or Ameritrade or any of the assets that we manage for you. They all act differently. So if you don't know the specifics, since I don't know which accounts that you have, please call me, please call BJ to our office, that we'll give you the exact answers based on where you have your accounts with.
Okay, the next question, if you take your RMD and pay the taxes, can you put it into your Roth after you are retired?
Well, that's part of the thing that I went over. Normally, you could not do that, but remember what I said, the things have changed now in 2020, which means that if you work, you could have a traditional IRA and a Roth IRA beyond the age of 70 and a half or beyond the age of 72. So the idea is, if your question is taking the money out of your IRA and not pay taxes by putting it into Roth, it can't be done. You still have to pay taxes. So why would you want to do that, you know, if that's the case? This is a great opportunity to do that in 2020, and that's the only year that you'll be able to do some of that. So give me a call, then I'll go over with you specifically how much of that you'll be able to put away right now.
Okay, the next question, I am over the age of 75. If I want to take out $100,000 this year from my 401k, will I be able to spread the taxes over 3 years rather than paying it all in 1 year?
Providing, answer is yes and no. Providing that you meet the qualifications of coronavirus distribution. Remember, I went over, there are a few things you have to be. You have to be quarantined, that you've been furloughed, you've been laid off, you need the money because you cannot find a babysitter to watch your kids. Now, here's a question that I'm not sure of, but I'm sure you're also good with the grandkids too. But that's something that you need to tax your tax advisor about. But there are things you have to be qualified in order to do that. But that's a great question. And if you're able to do it, take advantage of it.
Okay. I am 65 years old. Is it feasible to convert my TSP to a Roth IRA?
Answer is yes. You could do that, providing you're able to pay taxes. So either you have extra money. Here is the number that I use. That's a $100,000 TSP. You want to convert that to Roth. Let's say it's still worth $100,000 today. If you convert that $100,000, that $100,000 will be added to your income as though you made it this year. So the answer is yes, you could convert it, but you got to pay taxes. Where are you going to get the money to do it? If you have money sitting in the bank, not earning anything, that may be a great opportunity to use that money to go to work for you. If not, you may have an opportunity to use some money sitting in a account that you may really not need, but you kept it there for just in case. You may want to do that. But whatever the case, I cannot give a 100% answer to it because I don't know your financial situation. But if you call me or meet with me, I'd be more than glad to give you the exact answer you're looking for.
Okay, and this is going to be the last question. So if anybody else has any further questions, you can email us or give us a call at the office, and we can certainly get back to you. But the last question for today is, I am retired and I'm currently taking my RMD. Can I put it into my Roth?
Again, that's the very similar question, but in order to put them in the Roth, it has to be an earned income. It can't be money from it's not a rollover, so you can't do that. You cannot roll over money from a traditional IRA to Roth IRA. If in that situation, because you're taking the RMDs, or you need, that money has to be paid, you have to pay taxes on it first. But with the new law that you're able to put money away beyond the age of 70 and a half, that you may want to think about doing that instead.
Okay, and that's everything, Randy.
Well, I want to thank you again for joining us today. We had almost 40 people, I believe. I think almost 50 signed up. So I want to thank you for spending your afternoon with us. We're going to be doing this every Wednesday at noon. We're certainly will be talking about in next 3 weeks, just to give you the date. On May 6th, we're going to be talking about 401k, 403b, and IRA loans, and what to do in this crazy market. And on May the 13th, we're going to talk about Social Security, how to reduce your taxes by utilizing the new tax acts and options that's given. And on May 20th, we're going to talk about charitable giving. So please join us. Look for the email that I'll be sending out on Thursdays. And certainly sign up so that we could get you the proper sign up email to you. Joe will be doing that. And I want to thank you. I want to thank my staff for setting this thing up today. And be safe.